The 5 biggest investing mistakes that will keep you poor. Most investors are losing money, and they don't even realize it. One mistake could cost you thousands, or even millions. Let's make sure you're not one of them. Whether you're new to investing or have been doing it for years, avoiding these common mistakes is critical to building wealth. In this video, I'll break down the 5 biggest investing mistakes that could be sabotaging your financial future, and how to avoid them. And at the end, I'll reveal the one investing trap that even experienced investors fall into, and how to avoid it. Let's get started. 1. Chasing hype stocks and meme investments. Many investors fall into the trap of chasing hype stocks, jumping into investments just because they're trending on social media or skyrocketing overnight. But emotional investing almost always leads to losses. Why this happens? Fear of missing out, aka FOMO. Many investors buy in after a stock has already surged, hoping it will keep climbing. Unfortunately, by then, it's often too late. Lack of research. Investing based on hype instead of a company's actual financial health leads to poor decision-making. Real-life example, during the GameStop and AMC stock rallies, early investors made big profits, but most people bought in at inflated prices, only to watch their investments crash. How to avoid this mistake. 1. Always research a stock before investing. 2. Focus on companies with strong fundamentals, consistent earnings, growth potential, and a solid business model. 3. Don't chase trends. Investing is about long-term wealth, not quick gains. But even if you avoid hype stocks and only invest in solid companies, there's another mistake that could still cost you: trying to time the market. Let's talk about why this strategy almost never works. 2. Trying to time the market. Another major mistake is trying to predict market highs and lows, a strategy known as market timing. While it might sound logical to buy low and sell high, even professional investors struggle with this consistently. Why market timing fails? Unpredictability. Markets are influenced by countless factors: economic data, geopolitics, investor sentiment that are impossible to predict accurately. Emotional decisions. Fear during market dips and greed during rallies often lead to poor timing. The alternative, dollar cost averaging, DCA. Instead of trying to time the market, adopt a dollar cost averaging strategy. This means investing a fixed amount regularly, monthly, bi-weekly, no matter the market conditions. Buying more shares when prices are low, fewer shares when prices are high. Why DCA works? It smooths out market fluctuations. It reduces the risk of making emotional decisions. Example: imagine investing $100 every month into a stock. During a market crash, your $100 buys 10 shares. During a bull market, it buys only 5 shares. Over time, this averages out your cost per share, reducing volatility risk. Historical context. During the 2008 financial crisis, many investors panicked and sold. But those who stayed in the market and kept investing saw huge returns in the recovery. So, we've established that timing the market doesn't work. But even if you invest consistently, there's still one major mistake that could destroy your portfolio: putting all your money in the wrong place. Let's talk about the dangers of not diversifying your investments. 3. Not diversifying properly. The old saying, "Don't put all your eggs in one basket," applies perfectly to investing. A lack of diversification exposes your portfolio to unnecessary risk. The risks of overconcentration. If you invest heavily in one stock or sector, e.g., tech or crypto, you're vulnerable to major losses if that investment underperforms. Even stable companies can collapse unexpectedly. Think Enron or Lehman Brothers. What proper diversification looks like. A well-diversified portfolio spreads investments across different asset classes, such as 1. Stocks, large cap, mid cap, and small cap companies. 2. Bonds, provide stability during downturns. 3. Real estate, Consider REITs if owning property isn't feasible. Fourth, international investments. Reduce reliance on domestic markets. Diversification helps because if one investment drops, others may rise, balancing your returns and reducing risk. Diversification strategies. 1. Asset allocation. Decide how much to invest in stocks, bonds, and real estate based on your risk tolerance. Second sector. Diversification. Spread investments across tech, healthcare, finance, and other industries. 3. Geographic diversification. Invest in both domestic and international markets. Now, imagine building the perfect portfolio, only to watch it slowly lose money, without you even noticing. Hidden fees and taxes do exactly that. Here's how to stop them from eating into your profits. 4. Ignoring fees and taxes. High fees and taxes quietly drain your wealth over time. The impact of fees. Investment fees, mutual fund management fees, financial advisor fees can cost you thousands over decades. Example: a 1% annual fee on a $100,000 portfolio growing at 7% could cost you nearly $100,000 over 30 years. How to minimize fees and taxes. Choose low-cost index funds and ETFs over high-fee mutual funds. Use tax-efficient accounts like IRAs and 401ks. Hold investments long-term to benefit from lower capital gains taxes. Warren Buffett started investing at 11 years old with a clear plan. Today, he's worth over $100 billion. Having a solid investment plan isn't just for the ultra-wealthy. It's what separates successful investors from those who lose money. Let's talk about why. 5. Investing without a long-term plan. Many people start investing without clear goals or strategies. This often leads to inconsistent results. The importance of a long-term plan. Investing is most effective when aligned with specific goals: retirement, home purchase, education. A plan keeps you focused during the market volatility. Steps to create an investment plan. Define your goals. Set clear, realistic investment targets. Assess risk tolerance. Invest based on your comfort level with risk. Automate contributions. Set up automatic investments to stay consistent. Now that you know the 5 biggest investing mistakes, here's the real question. Are you making one right now? Even one of these mistakes could be holding you back. Let's quickly recap to make sure you're on the right track. Let's summarize. We covered 5 huge investing mistakes: chasing hype stocks, trying to time the market, not diversifying, ignoring fees and taxes, investing without a plan. Now be honest, which of these mistakes have you made? Drop a comment below. I read every single one. Hit that like button and share this video, because I guarantee someone you know is making these mistakes right now. And don't forget to subscribe so you don't miss more investing tips that can change your future. See you in the next video.